And let's get into the crude space now, where we have seen the prices go for a correction this week. The U.S. crude declined 3.3%, while Brent is down 1.5% as well. However, as far as India is concerned, it was a double whammy because on one side, we saw the crude oil prices holding firm, and on the other side, the rupee went to all-time lows, and that is a recipe to increase India's import crude bills for sure. Miswin Mahesh now joins us to talk more about that. Miswin, hi. Thank you for joining us. What has been, first of all, your sense on the crude oil prices? Because right from supply-demand numbers to the macro situation that we are into, and of course, the kind of trade fears that seem to be looming around, crude prices seem to be taking cues from all of that.
Yes, I think you've summarized it quite well there. And the one thing that I'd really add here is November is very much the key date for oil. You've got the US midterm elections that's capping oil prices now because the Saudis don't want to increase the price going into the US midterm elections because Trump is very sensitive about it. And in November, you've also got the Iranian sanctions getting applied in full force. So November is a key month for oil because it's from November that we actually see oil prices rise strongly. So up until then, we'll be range bound with a lot of volatility, but it's November that's on the radar for most oil traders at the moment.
Oh, well, absolutely. And what's also your sense on the OPEC then? Because I understand that we have that deal of output cuts only until December this time around. There is going to be an OPEC meeting as well. And then OPEC saying that 100 million barrels per day of a global demand may see a breach coming in this year. How are you reading into all of that?
Yeah, so OPEC's going to have a fairly hard meeting this time around because you've got the Iranian sanctions kicking in. And there's a lot of confusion as well with regards to what Saudi Arabia is actually producing, because they've been given, initially, if you remember, in July, they gave guidance to the market that they were boosting production. Then they turned around and said that they were not boosting exports as much as previously expected. So the market's really looking for a better signal from the Saudis this time round. What exactly are they going to do? Are they going to backfill on what the Iranian volumes that will be lost, or will they hold output at 10.5 million barrels per day? So that will be one thing to watch out for. The second key thing would be what Russia, as well as the other non-OPEC countries, do. It is my understanding that demand at the moment is strong, and that's part of the reason why we saw the rally in oil prices just a few weeks ago. Refinery margins are doing well, and that's part of the reason why crude is being demanded, especially sour crude grades. But going into Q4 with a lot of the emerging market volatility that we've just discussed, I think there is a small concern now that the demand growth number may not be 1.5, 1.6, but maybe 1.3, 1.2 million barrels per day. But that's not that big of a concern for OPEC because they're producing close to spare capacity in any case.
Oh, well, yes. I also want to bring in Jonathan. Jonathan, what is your sense? Because we almost did $80 in the previous week. Of course, we've seen some correction. This week isn't going down on a positive note. But as Miswin is also pointing out, with Iran sanctions, also the U.S. weekly inventory data decline, what is your sense on prices?
Look, I actually think that the crude oil market, particularly Brent, has been in a range for some time, as with WTI. And I think that range is going to continue. I think at the end of the day, the market sought for a range and nothing too out of the ordinary for crude, and I think it's behaving that way. When I look at the Brent contract, I think 80 is a very, very tough resistance. I actually don't see it breaking through there, that level. I actually think it'll hold for the next quarter. When you start to think of some of the geopolitical news coming out, I get a sense that the US is trying to move away from a tightened market, which we already know is already in play. And I think the interesting thing, by offering waivers, say, to India, I think that was a very positive thing because it doesn't put that sudden jerk on the market which says, hey, tightness is here. So, yeah, looking for a range, but looking for it to stay in the range and probably see prices come back a little from here.
Okay. Miswin, what is your sense? Would you agree with Jonathan that $80 is not going to breach, or is that a possibility in the final quarter of this calendar year?
I'd agree with Jonathan only for this current quarter that we'll stay within a range. As mentioned, it's November that the Saudis are sort of maintaining $70 to $80 range. from the fourth quarter, I wouldn't be surprised with an $85 per barrel or even a $90 per barrel price. Three key reasons for it. One, the market is getting a bit complacent about the Iranian sanctions. A lot of the waiver talks sort of really feeding through the wires. And the thing to really remember here is one, countries can say we're giving a sanction waiver, but ultimately it's the company that decides whether to import the crude or not. And a lot of companies wouldn't want to take that risk, whether it be public sector companies in India or private sector companies. The government can give them waivers, but they may still not import Iranian oil. The second key thing is we're in a very razor edge market at the moment. Saudi spare capacity is being tested. There isn't a lot more to be added. And there's also quality issues that are coming through on oil. And the third thing is US production. US production is capped. We're already seeing initial signs of plateauing, if not slowing down of growth. And there isn't anyone who can provide that extra barrel in Q4. So I would think we'd go higher before we go lower next year.
You're not the bearer of good news here then, Miswin, because, we've already seen the crude import bill ballooning in India, the numbers that we are dealing with in the month of August. So if you're looking at 85 to 90 kind of crude levels, what is the strategy that you would look for India then? Because the way rupee is going, the way we've seen diesel and petrol prices at all-time highs already ruling in India, how would you look at India as a consumer?
Yeah, so I think the government is done a great thing at the moment by not decreasing consumption taxes. It does need to have a pro-reform policy in place because you do need to slow down consumption growth. That is the way. Subsidizing it is not the way. But subsidizing it just kicks the can down the road. It just means that Indian consumption will continue to grow. I think there needs to be a tempering of growth, and the $85 to $90 per barrel that I signaled essentially will make the market reduce demand growth, or rather slow down in terms of the pace of consumption. So that's how we balance the market.
I also want a number on demand and supply from you because even as we do talk about an increase in demand, what's your sense on the supplies? Because all we seem to be getting indications of is further increase in US shale output, so US output on one side, and then the Russian output, the Canadians, the OPEC and the Saudis, etc. Going forward, how are you looking at the supply picture emerging?
Great question. US production, I feel the US production growth will start flatlining from now up until July next year. And that's the key for the oil market here. There isn't a lot more incremental that they can produce and send through pipelines because all the pipelines are being used. Key US oil operators such as and people who are involved in the sector, such as Halliburton, et cetera, have already started signaling that they are seeing a slowdown in the Permian Basin, for instance. The key growth or surprise that we could potentially get could be if we start seeing some of the other non-OPEC producers boost production. But even there, I think the margin is very, very little. I think Q4 is looking very constructive for oil. Margins are doing well. There isn't a lot of supply. And saw crude grades are on fire at the moment. And sweet crude grades are just following that trend. Come next year, though, I think once US production comes back from July, we'll start seeing softening, and also as demand starts softening. But for now, this freight train is going at full speed. And the current jitters in terms of emerging market fears, etc., it's a lot more to do with fund flows rather than a reflection of how weak emerging market economies are.
Oh, well, absolutely. That, of course, has been a concern. So it may not actually be the global trade concerns that could impact India going forward, but the crude oil prices where the near term could be range bound, but going forward, levels of $80, $85, $90 per barrel also are not ruled out. Miswin and Jonathan, thank you. We'll let you go at that. It has been a pleasure having a conversation with all of you guys. But with that, it's wrap on this edition of Commodity Champions. Thank you so much for watching.